Hello, and thank you for tuning in. In today's presentation, we will be focusing on personal financial planning for young professionals. This presentation is brought to you by the California Society of CPAs. My name is Daryl Young. I'm a volunteer board member and the chair of the Financial Literacy Committee for the Peninsula Silicon Valley chapter of CalCPA. I operate a wealth management practice in the San Francisco Peninsula area. We intend for this presentation to be interesting and informative. The data points contained herein are believed to be current, but please note that this presentation is intended to convey general information which may not necessarily be applicable to your personal circumstances. Please do not interpret this information here as specific advice for your personal finances. You should consult with your financial advisor, or certainly feel free to give my office a call. Again, we will be looking at personal financial planning for young professionals. We've got an ambitious agenda for today. I find it very interesting to talk about this, and I hope you do as well. But before we dive into it, I want to emphasize what I believe to be the cornerstones for personal financial success, and those being planning in accordance with your goals and your risk factors, giving back to your community, working with people whom you respect and trust, and maintaining a positive attitude and a competitive awareness at all times. If you are following these four actions, I believe that you have the makings for financial success. It is also my belief that time is our most precious resource, and there are no shortcuts to financial success. Let's take a look at our current financial environment. And here, of course, we as young professionals have gone through what might certainly be thought of as the Great Recession, or the worst economic period that we've seen in our working lifetimes. You'll notice on the right-hand side a chart which represents the S&P 500 stock index going back 20 years. You'll notice that we saw the tech bust of 2000. We saw the credit burst of 2008. And now, here in the late part of 2014, the stock market has since recovered and has reached new highs. There on the right, there are some other statistics for us, taking a look at what our Fed has done, keeping interest rates near zero. We're seeing in the most recent quarter GDP growth in the 3.9% range, and having come off the lows of the recession, we're seeing the nationwide unemployment rate at 5.8%, a much improved number as opposed to near double digits, which is what we were seeing at the worst part of the recession. So this would seem to be good news. And how about some other governmental factors, though? Our national debt is approaching $18 trillion as a nation. 2014 tax rates, and let's assume a single filer with an $80K salary, you're looking at 25% federal, 9.3% California. And taking a look at another government area, Social Security and Medicare, I think many of us follow the news, and the projections would show that Medicare will be depleted by 2026, Social Security depleted by 2033, unless changes are made. So what is a young professional to do in this environment? Now, let's understand how we define a young professional first and foremost. I think that oftentimes we hear the word millennial or Gen Y, and I think that some of the characteristics that you see here on this slide compare and contrast millennials with the previous generation, Gen X, and the generation before that, the so-called baby boomers. Based upon various research and studies that I've seen, it seems to be that millennials grew up in a more nurtured environment and perhaps have more of a sense of individualism as compared to previous generations. Myself, I belong to Gen X, and we're thought to be skeptical and tend to exhibit lower market confidence with respect to the idea of investing. Anyway, these are some interesting thoughts, I think. And again, we're focusing today on young professionals in the millennial, quote-unquote, space. Now let's take a look at a profile of a young professional. Here we have a diagram of Milton the Millennial. And we can see some of the major aspects of Milton's personality and professional life. This is a person who is technologically savvy. You can see that Milton here uses the various tools such as Facebook, Twitter, some of the larger names that are familiar to us. Milton here, as compared to previous generations, is delaying certain milestones in his life, such as first-time home buying or delaying the age at which he gets married. Milton is also shown to be a little more risk-averse with respect to how he might invest. And that, of course, makes sense given the fact that, as we saw in a previous slide, we've just been through a great recession and probably the sharpest downturn that Milton has seen in his professional career. And Milton here is also burdened by inordinate amounts of debt, some of which might be due to student debt. Now, having said all that, what would a financial plan do for Milton? I would say that a financial plan helps Milton articulate and track progress toward his personal goals. Might also be family and business goals. The various elements included in his plan might be things such as retirement, investing, could be things such as tax strategies, caring for dependents. But let's not also forget risk management. After all, life is a series of ups and downs, and I think that a plan should help plan for the positives in your life, but then also help you prepare for adverse consequences. Now, what might a financial plan actually look like as a document? You see here on the right-hand side, we've got a snapshot of what a summary page might look like. And of course, it helps Milton prioritize his goals, certainly the things that he needs in life versus the things that he wants, and then finally the things that he may simply wish for. Naturally, the plan takes into account income from salary, investments, etc., expenses, and having married all of those items together, the financial plan becomes a formal document helping Milton achieve his goals in a time frame that he is comfortable with. Now, is Milton living the American dream? Well, statistics would say that 71% of millennials believe themselves to be in control of their finances and can achieve their goals. And what might those goals be? Well, I suppose the typical American, having graduated from college, moving left to right in the diagram, would hope to get a decent job, build some credentials, such as the CPA, pay off any debts, get married, enjoy life, travel, buy a home, raise a family, send those kids to college, and retire comfortably with perhaps even some leftover to be inherited by heirs. Now, that all sounds great, and again, I believe this to be the so-called American dream. But what if that dream, at least for now, seems more like a nightmare to you? What might that be? Extended periods of unemployment, having to undergo a career change, perhaps started in a business and it unfortunately failed to survive. The long-term thought of running out of assets in retirement, extended illness, premature death. There are all sorts of things, again, that a financial plan may cover. So not just the positives, but also perhaps the adverse consequences in life. Now, here we see some of the challenges that millennials might face, and I'd like to focus on the upper left-hand pie charts. You'll notice that between 2005 and 9 years later, the amount of the pie that's taken up by student loans has grown dramatically. And I would say that that is indicative of a lot of students these days, given the ever-escalating costs of education. And from an economic perspective, that might help to explain why millennials, young professionals, could be delaying certain milestones in their life. Again, when we looked at the profile of Milton earlier, we noted delayed with respect to first-time home buying, delaying getting married. Now these, of course, may be due to several factors, not just an accumulation of student loans. But I highlight that because I do understand that to be one of the bigger issues facing young professionals these days. And it should also be noted that typically student loan debt cannot be forgiven in bankruptcy. How about some other challenges for millennials? Well, if your goal is to get married, studies show that the national average for a wedding is just under $30,000. That would include everything from the venue, the reception, photography, videography, outfits, entertainment, flowers, rings, etc. And where might those funds come from? Well, if you're fortunate and you've planned, perhaps you have some savings, perhaps your family is able to help you, or you might actually have to take out some debt. Ideally not credit card debt, but again, for the things that we all wish for in life, sometimes we do what we do. Now, what are some of the alternatives? Of course, simplifying it by having just a civil ceremony, postponing or eliminating the reception and the honeymoon altogether. These are also ideas, I think, for young professionals as far as trying to manage in the current economic environment. How about the challenge of buying a home? Well, we here in the Bay Area, of course, are subject to higher home prices than the average around the nation. Latest studies would indicate that the Bay Area median price of a home is $770,000. And of course, if you follow the traditional ideal down payment of 15 to 20%, what might those numbers look like? Well, there on the right, of course, you see that the ideal 20% down payment would amount to $154,000 on a $770,000 home. That by itself would seem to be a fairly significant hurdle for most young professionals. But let's say you were able to come up with that as a down payment. What would you be left with? Well, you'd be left with nearly a jumbo mortgage at $616,000, and at today's interest rates, that might amount to a monthly mortgage payment of $3,100, and that should be defined as just principal and interest, not necessarily taking into account taxes and insurance. I would say that in order to actually afford a house like this, the household income would have to gross $14,000 a month just to feel like you've got some breathing room. Now, that could be a husband and wife both working, but as we'll see on the next slide, if a child enters the picture and one parent stops working to raise that child, that certainly affects the equation here as far as managing your home expenses. And so what about raising a child? Government statistics report that bringing a child into this world and raising that child until 18 would cost nearly $305,000. That's certainly a daunting figure for most families, and that covers a lot of things, and of course that is over 18 years, but again, if you take government data at face value, that is what the figure would suggest. Now, how about if you're planning to help your child beyond 18, for example, with college? A number of different vehicles are at your disposal, such as College 529 plans and Coverdell educational savings accounts. Those are quite nice options because they do provide a tax benefit of some sort. What about the cost of the education itself? Well, again, we here in the Bay Area of California, let's look at the UC system, which is a top-tier in-state public system. There in the center columns of those bar charts, you'll notice that a one-year cost of attending a UC these days is in the mid-$30,000 range. Now, fast forward 18 years, inflation adjusted, per year, that cost will approach $80,000. How about some perhaps unexpected challenges, such as caring for other family members, whether they be your parents, siblings, cousins, what have you, and those costs can come from all different sources: medical, educational costs, just the expenses of daily living, or perhaps helping to absorb existing debts. Again, I think that when you look at financial planning, the key thing is to consider who is involved in your plan, and it may not just be your nuclear family, a person, a spouse, children. You might actually have other folks, again, such as parents, siblings, cousins, whom you are trying to help. Now, let's say that we just want to look at retirement, though. How much might a young professional need to retire comfortably? This particular chart I created because I think that it helps to explain from left to right the typical course of life. Grow up, gain an education, start working, and start accumulating savings. And those savings are nibbled away by inflation, which is the dark blue, and the taxes, the light green, such that what you're left with is your net assets, that area in yellow. And ideally, you live your life accumulating assets and savings, and then you reach a point where, let's say that you retire, and then you start to draw down on those assets, and whatever is left at the end of your life goes to your heirs. Now, what might those equations look like for, let's say, a person who, inflation adjusted in today's dollars, spends $3,000 per month or $36,000 per year just to live, and assuming that a rate of inflation is 3% on average, and that in retirement your money, while you're spending it, is still working for you at some rate, call it 4%. As a side note, let's take a quick look at Social Security, because most Americans would utilize Social Security as approximately 1/3 of their retirement income, so a fairly significant figure. Now, as you can see in the stat here, 35% of millennials do not expect to rely on Social Security, and that makes sense given one of our earlier slides looking at the time frame in which Social Security is projected to be depleted. Now, knowing that Social Security might not be relied upon, it is interesting to note that over 50% of millennials are putting away no more than 5% of their income toward retirement. And that is, I think, again, a function of debts that may have accumulated due to student debt or other various factors. But let's get down to some hard numbers here. Now, this is an excerpt of a spreadsheet that I had created to help somebody easily identify a target for retirement. So again, if we take a look at a person who desires to retire at the full retirement age in accordance with Social Security, which is 67, and God willing lives until 92, so that implies 25 years of retirement. Let's further assume that the housing situation or the mortgage of the home will be paid off, and that there are no dramatic increases to taxes, unexpected dependents, etc. If you're able to save at a rate 3 times your monthly spending per year, what I show here in the slide is for a person of 30 looking to retire at age 67, using a spend rate of $3,000 per month in today's dollars, that person would need to accumulate approximately $2.6 million free and clear at the point of retirement at age 67. Now, of course, to be on track for that mathematically, how much should you already have right now? Well, that same 30-year-old should have just under $170,000. Well, those are my numbers anyway. But I offer this to you because I believe that it is a fairly easy way to set a retirement target for yourself based upon your spending habits. Now, how about investing? Here we have a chart which shows the efficient frontier between stocks and bonds. And the takeaway from this is fairly simple. If you have a person who is fairly aggressive and by definition invests the entire portfolio in stocks 100%, that would suggest to me that the person is looking for a double-digit return, as you can see on the left, greater than 10%, and is willing to absorb, call it 25.5% in terms of volatility or standard deviation. Now, that might just sound like statistics to you, so let's take a look at the next slide, which puts in perspective what that might actually mean. So again, that person who is fairly aggressive with 100% stocks might be represented by the far right strategy, strategy 6. And so, on average, the person is getting that double-digit return of 11 some odd %, and in some better years actually does over 20%. However, in bad times, that person will feel downside volatility of close to 18%. So again, if you are willing to be aggressive, know that that subjects you to higher rate of volatility, and hopefully that helps you put your strategies in perspective with respect to investing. What kind of accounts are available to you? Well, of course, I think most of us are familiar with 401ks and more recently Roth 401ks. These days, looking ahead to 2015, we know that the maximum elective deferral in 401ks is $18,000. So to look at that simply, if you have a person in the 25% tax bracket making $80,000 a year, and that person chooses to defer 10% of gross salary, well, that would be a contribution of $8,000, which is far below the actual maximum that the person can do. Now, Roth IRAs and traditional IRAs have the same maximum contribution for 2015, which is $5,500. And these numbers that I just gave you are different if you happen to be age 50 or above. But again, we're focusing on young professionals for the purposes of this presentation. Now, perhaps you've exhausted all of your tax-advantaged choices and you have a brokerage account. Perhaps you've opened up a custodial account for your child or another youngster. So there may be any number of different combinations of accounts that might suit you. And if you need some help understanding these choices, or if you need some help putting together your investment strategy, my suggestion to you is to speak with your advisor. How about the types of securities that one might invest in? Well, I think that most of us are familiar with stocks and bonds. We've probably heard of mutual funds and exchange-traded funds. Having an expertise in investing is in and of itself its own topic, not one that we can cover in this particular presentation. But I think that it's certainly common knowledge to most people that being diversified is a key aspect of successful investing. And finding the asset allocation, the balance, for example, between stocks, bonds, cash, and real estate, to you as an investor, finding that right balance is, again, an important aspect of generating a successful result. Again, as I mentioned earlier, when we talk about financial planning, it's not just planning for the positives in life, such as getting married, raising a family, raising children, putting them through college. But what about potential adverse consequences? I actually found it somewhat surprising that a government statistic revealed that nearly 1/5 of our population is disabled in some way. Now that, of course, could be minor or severe, but just the stat itself, to me, was rather surprising. And now, if you look at that as compared to the rate of so-called premature deaths, you'll see that the rate of disability is much higher. Now, to me, the takeaway from that is, if you're looking to allocate resources between one or the other, I would say that there's a likelihood, higher likelihood of being disabled than a likelihood of premature death. So consider that in your planning. Perhaps you've also thought about long-term care. Perhaps you've also looked at annuities. And again, these are all vehicles that may provide some risk management benefit to your financial plan. We've actually tried to cover a lot today. We've looked at financial challenges for millennials. We've looked at creating a financial plan and all the things that it can address. We've looked at the economic environment and saving for retirement, saving for growth. One of the tougher things to cover in a presentation such as this is helping folks prioritize. So for example, if you are living within your budget and you ask me, but Daryl, how do I choose between paying off my student loans earlier versus putting away money in my 401k versus putting money away into a fund so that I can buy a house someday? And I'd say, that's a great question. It's hard to answer that in real context without knowing your personal circumstances. And frankly speaking, it's not the kind of question that can be answered in a general presentation such as this. I would certainly encourage you to speak with a financial advisor who might be better able to assist you. Now, topics for future discussion. Hope that we have the opportunity to discuss in deeper detail home buying, investing, perhaps employee stock options, estate planning, tax planning. These are all topics that you can spend an entire presentation or even a series of presentations talking about these various areas. I really hope that this has been an interesting presentation for you. I've certainly enjoyed it. I find personal finance to be a fascinating subject, although I recognize that it's not necessarily fascinating to everybody. I really hope that you found this time to be worthwhile. Thank you for your attention, and I wish you the best.